With those Big Six Q4 earnings out, it is time to look in on the Big Six Canadian banks and see just how they did. Hold on to your seatbelts, folks. This is going to be a good one. The Big Six refers to the six largest banks in Canada, which are, of course, renowned for their influence, stability, as well as their huge presence on both the national and international stages. It goes without saying that these banks form the very backbone of Canada's financial sector. In fact, they not only play a pivotal role in the Canadian economy, but also have a significant footprint in global financial markets, reflecting, of course, Canada's strong and well-regulated banking system. Historically, the Big Six have demonstrated remarkable resilience and stability through both the good and the bad economic times. They have led the way via prudent risk management, conservative lending practices, and strong capitalization. These banks have successfully navigated some of the worst times, including the global financial crisis of 2008. Their ability to maintain profitability and operational integrity during economic downturns is often attributed to stringent regulatory oversight and a focus on a diversified revenue stream. In periods of economic growth, they have capitalized on expanding markets, both domestically and internationally, exhibiting steady growth in assets and, of course, their customer base. This consistent performance has not only cemented their reputation as reliable financial institutions, but also positioned them as some of the most stable banks globally, underpinning the strength and stability of the Canadian banking system. The Big Six is currently in one of those economic challenges, as those pandemic-era low-rate fixed mortgages come up for renewal in 2024 and 2025. There is going to be challenges for the banks. The rates being significantly higher now is going to lead to higher renewal rates, no matter how you slice it. A lot of mortgage holders are going to be strained financially to the max, and some even beyond the breaking point. The banks are going to have to navigate a very narrow ledge of maintaining profitability while supporting as best they can customers who are struggling with the increased payment scenario. There is this little thing called loan loss provisioning, which is going to be a huge factor in how well the banks do on the profitability side. In a nutshell, loan loss provisioning is a financial practice where banks set aside a certain amount of cash to cover potential future losses from loans that borrowers may fail, of course, to repay. This reserve acts as a buffer to protect the bank's financial health against the risk of loan defaults, ensuring stability and compliance with regulatory requirements. The Big Six are storing away quite a big chunk of cash for the wave of defaults expected as these renewals come up in 2024 and 2025. Some banks are estimating up to 60% of their mortgages are due for renewal in this time frame. On the bright side, the rate hikes have had an impact on the economy, and we have not yet seen the full effect, as there is a lag between hike and effect. With the economy slowing down, there is a chance that we can see rate cuts in the second half of 2024, and this would be a great help for mortgage holders. There will still be a lot of defaults, but maybe a rate cut or two before then can save some of those home owners. Join the conversation. Let us know in the comments if you hold any of the Big Six. Your participation is, of course, well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a huge thank you for that click. I definitely think I talked enough about the generalities of the Big Six. Obviously, the key point today is to figure out which of them are staying more or less on target with their profitability goals. Make no mistake, they are all struggling to some degree and will continue to struggle as we move through the mortgage renewal issues of the next 2 years. And just to be clear, we're not doing deep dives here today. We will, though, be looking at a few key points, such as how they did compared to estimates, their fair value, as well as earnings and share price projections for the next year. We will also rank them at the end in terms of who is going to give you the biggest total return. So without any further ado, let's do this. We will start with Scotia Bank. They've got a ticker of BNS. When it comes to their Q4 earnings, they were expected to hit a EPS of 1.65. They actually came in at 1.26, so they missed expectations on this one. Thus, we're going to rank it as an arbitrary fail. Their dividends come in at $1.06 per share. That is a nice looking 7.24% yield. There was no change at all to their dividend. Their earnings growth in the next year is projected to be 7.24%. Their fair value comes in at $108.31, so that does mean that they are undervalued by 44.4%. Now, their current price, $60.26, of course, at the time of recording. When we look at their one-year forecast, they are projected to finish 2024 at $62.77. So we're only looking at about a 4.2% growth on that stock. When it comes to Scotia Bank, they did have a pretty big miss, and the 1 year out projections are not fantastic, unless of course you are hoping to continue stacking shares with that nice dividend yield. Next, we will take a gander at Royal Bank. So their expected EPS was $2.65 per share. Their actual came in at $2.90 per share. So they totally exceeded expectations. So they do get that pass. Their dividends come in at $1.38 per share on a yield of 4.45%. They did raise their quarterly dividend by 3 cents, so that's pretty good. Earnings-wise, their earnings growth is expected to increase by 3.57% over the next year. That's not a lot. Their fair value comes in at $186.66. That means that they are undervalued by 33.6%. Now, their current price is $124.49. Their 1 year forecast, that comes in at $129.75. So that is a growth of 4.6% on their share price in 2024. Once again, that's not a really great number. Even with the pass, the overall projected returns in 2024 are not great with this one. I do not expect them to do well in the total return rankings that we're gonna do right after we finish these report cards. A lot of investors really love TD, so we will do them next. Their EPS was expected to come in at $1.91. It actually came in at $1.49. They missed expectations quite a bit, so they will get that fail. Now, their dividends are firmly at $1.02 per share for a yield of 4.97%. And they did add 6 cents to their quarterly dividend. Their earnings growth looking to come in at 9.38%. They have a fair value of $131.30. That does have them undervalued at 37.5%. Their current price is sitting at $82.36, and that 1 year forecast is expecting growth up to $87.56 in 2024. That's a 6.8% growth rate. The 1 year forecast is looking better, though with a lower dividend, we may not be top of the total return leaderboard. Up next, we have a CIBC, ticker CM. They were expected to come in with an EPS of $1.55, though they came in at $1.53. Wow, they just missed it by a wee bit. They did miss expectations, but really not by a lot. It is still a fail. Nonetheless, though, a very, very weak fail. Their dividends are set at 90 cents per share. That's on a 6.26% yield, not too shabby. They did raise their dividend this time around by 3 cents. Their earnings are projected to grow by 11.39% this year. That's looking good. They have a fair value of $112.36. That does put them undervalued at 48.8%. Their current price at the time of recording was $57.72. Their 1 year forecast, $60.74. So that's a 5.7% growth rate. Their 1 year is looking a little better, and they do have a pretty good dividend yield. I do expect them to do well in the total return leaderboard. Coming in next, we got the Bank of Montreal, or BMO. They were expected to finish with an EPS of $2.86, but they came in at $2.06. They really did fall short of expectations, so they're going to be owning this fail. Their dividends are set at $1.51 per share on a 5.22% yield. Now, they did raise that dividend by 4 cents, so that's not too shabby. Their earnings growth, this is the best out of all of them, 21.69% this year. That's fantastic. When it comes to fair value, that comes in at $201.61. That does put them undervalued by 42.6%. At the time of recording, their current price comes in at $116.83, and their 1 year forecast is $126.10. So they're expected to grow in 2024 by 8.9%. That's really good. I like that number. With a solid dividend and a good potential for growth in 2024, this one is going to be hard to beat. Finally, we have National Bank, their ticker NA. Their EPS was expected to come in at $2.25, but it actually came in at $2.14, so they did miss expectations, so they're also going to get a fail. I've been giving out a lot of fails today. When it comes to dividends, their dividend is $1.06 per share, and that's on a 4.5% yield, and they did raise that dividend by 4 cents, so that's fantastic. Their earnings growth is anticipated to grow by 7.64% in 2024. Their fair value, That comes in at $153.35, so it does make them undervalued at 38.6%. Their current price at the time of recording was $93.74, and that one-year forecast comes in at $100.70. So that's a 7% increase, so that's not too shabby. I still do like this bank, and there is potential here for some good returns in 2024. Okay, let's talk about those total returns. I am surprised with the results, and if you ask me who was the best based on total returns for 2024, I would have bet on CIBC, and I would have been wrong. The big winner in terms of total returns is BMO with an expected total return of 14.12%. That is not too shabby. CIBC comes in second at 11.96%. Then TD, National Bank, and Scotia Bank, they all come in very close behind. Interestingly enough, though, Royal Bank, who received the only pass, comes in dead last with a low of 9.05%. Holy banana bread, this was kind of fun. And if you guys want me to do it again after the next quarter, let me know, as I am game for sure. As usual, if you are interested in any of these bank stocks today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Keep the learning going. Watch my video on royalty stocks linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.